Have you ever wondered how interest rates affect the US markets? Interest rates, those seemingly small percentages, hold immense sway over the economy's pulse. They are the levers that the Federal Reserve, often referred to as the Fed, uses to steer the course of the US financial landscape. These rates are not just arbitrary numbers, they are carefully calculated tools that influence the cost of borrowing, the return on savings, and are a key weapon in the fight against inflation. The Fed sets the target interest rate, known as the federal funds rate. This significant rate has a ripple effect, influencing various sectors from prime interest rates to mortgage loan rates, and even consumer and business loan rates. It's a complex system of cause and effect, where a rise or fall in interest rates can spur significant shifts in the economy, impacting everything from your personal savings account to the broader stock market. So buckle up as we delve into the fascinating world of interest rates and their impact on the US markets. Ever heard of the federal funds rate? Well, it's more important than you might think. The federal funds rate, set by the Federal Reserve Board, is not just a number in the financial news, it's a key player in the economy's drama, influencing various interest rates and, by extension, our financial decisions. It's like the conductor of a grand orchestra setting the tempo for the performance. Let's consider its relation to the prime interest rate. The prime rate is what banks charge their most creditworthy customers, and it's usually a few percentage points above the federal funds rate. When the Federal Reserve adjusts the federal funds rate, banks adjust the prime rate in turn. So, if you're planning to take out a loan, the federal funds rate indirectly influences the interest you'll pay. Now, let's move to mortgage loan rates and other consumer and business loan rates. These rates don't mirror the federal funds rate, but they dance to its tune. When the federal funds rate goes up, borrowing becomes more expensive. Mortgage rates climb, making it costlier to buy a house. Car loans, credit card interest rates, they all follow suit. The same goes for businesses. Higher rates mean higher borrowing costs, which can impact their growth and profitability. On the flip side, when the federal funds rate goes down, borrowing becomes less expensive. Lower interest rates can encourage spending, benefiting consumers, businesses, and even farmers. It's like a sale at your favorite store. When prices drop, you're more likely to buy. But it's not just about borrowing and spending. The federal funds rate also influences how much we save. When rates are high, saving becomes more attractive. When they're low, not so much. So, whether you're a borrower or a saver, the federal funds rate impacts you. Thus, the federal funds rate plays a crucial role in our daily financial decisions. Interest rates and your disposable income, are they related? Indeed they are. Now you might be wondering how that's possible. Well, let's dive into that. Imagine you're sitting on a decent amount of savings. When the interest rates are high, the cost of borrowing money increases. This means that any loans or credit you might have become more expensive, which in turn reduces your disposable income. This is the money you have left after paying your taxes and other necessary expenses. With less disposable income, you're likely to cut back on spending. This reduced spending can have a ripple effect on the economy, leading to slower economic growth. But what happens when interest rates are low? This is where things get interesting. Lower interest rates make borrowing money cheaper. So, your loans or credit payments become less expensive, leaving you with more disposable income. With more money in your pocket, you're likely to increase your spending. This increased spending stimulates economic growth. It's not just beneficial for consumers like us, but also businesses and farmers. Businesses can borrow money at lower costs, which they can invest in growth and expansion. Similarly, farmers can afford to borrow more for their farming needs, potentially leading to increased output. All these factors contribute to a healthier, more robust economy. But remember, while low interest rates can stimulate spending and economic growth, they may also lead to increased inflation. That's a topic for another day. In essence, interest rates can shape our spending habits and lifestyle choices. They play a crucial role in our everyday economic life, whether we realize it or not. So, the next time you hear about a change in interest rates, think about how it might influence your disposable income and spending habits. It's more connected than you might think. Interest rates can even influence where you choose to invest your money. Imagine you're standing at a crossroad, with multiple paths leading to different types of investments. Each path represents an investment option, such as bonds, equities, or real estate. The signposts guiding your decision at this crossroad are the interest rates set by the Federal Reserve, specifically the federal funds rate. Now let's delve into why the federal funds rate is so crucial. It's the interest rate at which banks and other depository institutions lend money to each other, usually on an overnight basis. This rate indirectly influences the returns on various investments like certificates of deposit, also known as CDs, and U.S. Treasury bonds. When the federal funds rate is low, the interest earned on CDs and bonds typically decreases. Why is that? Well, lower interest rates mean cheaper borrowing costs, pushing businesses and consumers to borrow and spend more. This increase in spending stimulates the economy, reducing the need for safer investments like CDs and bonds. As a result, the returns on these investments tend to decrease. Conversely, when the federal funds rate is high, borrowing becomes more expensive. This scenario often leads to reduced spending and a slower economy. During such times, safer investments like CDs and bonds become more attractive. Their returns go up as more investors flock towards them, seeking stability amidst economic uncertainty. Understanding these dynamics can be invaluable when you're standing at that investment crossroad. It can help you decipher the signposts and make informed decisions about where to put your money. Each path has its potential rewards and risks, and the interest rate environment can significantly sway these. So, interest rates can be a compass guiding your investment journey. Can interest rates control inflation and recessions? The answer is yes. This may seem surprising, but let's delve into it. Interest rates are a powerful tool in the hands of central banks. They can turn the tide of a nation's economy. When faced with the specter of inflation, central banks can use interest rates as a control mechanism. Inflation, in simple terms, is when the price of goods and services increase over time. While a certain level of inflation is considered healthy for an economy, runaway inflation can be detrimental. So, how do interest rates come into play? Well, by increasing interest rates, central banks can dampen excessive spending. Higher interest rates mean higher borrowing costs, which can discourage individuals and businesses from taking out loans. This reduces the demand for goods and services, which in turn can help keep inflation in check. However, this isn't a magic bullet. There's a flip side. Raising interest rates too high or too quickly can lead to a recession. A recession is a period of significant decline in economic activity. When borrowing costs become too steep, spending slows down drastically. Businesses might cut back on investments and consumers might tighten their belts. This slowdown in economic activity can tip the economy into a recession. On the other hand, when an economy is already in a recession, lowering interest rates can stimulate economic activity and help end the recession. Lower interest rates make borrowing cheaper. This encourages spending, which can spur economic growth. In essence, interest rates are a delicate balancing act. Central banks must navigate carefully, raising rates to keep inflation in check, but not so much as to push the economy into a recession. Similarly, they must lower rates to stimulate a sluggish economy, but not so much as to ignite runaway inflation. Thus, interest rates can be a double-edged sword, controlling inflation on one hand and triggering recessions on the other. Interest rates and corporate growth, what's the connection? Let's find out. You see, when interest rates rise, it becomes more expensive for companies to borrow money. This borrowed money, or capital, is often crucial for businesses to invest in new projects, expand operations, or even just cover day-to-day expenses. So, when the cost of borrowing increases, it can put a damper on a company's growth prospects. Imagine a tech startup, for example. They need to borrow a substantial amount of money to develop their groundbreaking new app. But if interest rates are high, the cost of that loan could be prohibitive, causing the startup to scale back their plans or delay the project entirely. The result? Slowed growth and lower profits. Now, this doesn't just impact individual companies. It can have a ripple effect across the entire stock market. Investors, always with an eye on the future, may lower their expectations for a company's growth and future cash flows in light of these higher borrowing costs. And when expectations drop, stock prices often follow suit. But it's not all doom and gloom. Remember, interest rates can also go down. When they do, borrowing becomes cheaper, potentially sparking a surge in corporate growth. Companies can more affordably finance new projects, expand their operations, and in turn, increase their profits. This can lead to higher stock prices and a boost in overall market performance. The key takeaway here is that interest rates play a significant role in the financial health and growth potential of companies. They can influence everything from a company's ability to finance new projects to investor expectations and stock prices. Therefore, interest rates can be a key determinant of a company's growth trajectory and market performance. So that's how interest rates weave their influence on the U.S. markets. We've journeyed through the intricacies of the federal funds rate, understood its profound influence on consumer and business loan rates, and discovered how it can impact our disposable income. We've also delved into the significant role interest rates play in guiding investment decisions, and the ripple effects they have on inflation and recession. Moreover, we've seen how higher interest rates can make it more expensive for companies to raise capital, potentially impacting their growth prospects and stock prices. It's clear that understanding how interest rates work and their impact on the economy is crucial, not just for investors, but for everyone who participates in the economy. Did you find this video helpful? If so, please subscribe to my channel and like this video for more insightful content. Until next time, keep learning, keep growing.